Hi everyone, welcome to episode 14 of Learn on the Go. I'm sure you've all been noticing the Nifty 50 is at an all-time high. The broader markets are doing extremely well, but it doesn't hide the fact that there are over 3,000 companies where the share price has been down by at least 30% from its 52-week high. This is the query I used to get here. It's a very simple query. And understandably, most of the damage is concentrated in the small and microcap spaces. The other way of looking at this is that the valuations are now a lot more attractive. And if you have the metrics right, something that we've been discussing in many of the previous episodes, then discovering a high quality business that offers you a superior risk reward equation wouldn't be that difficult. Okay, let's try it on a screener. So let's go for small cap companies. So market cap is less than 10,000. So it's not small cap, it's more like tiny cap companies. And we need companies which are down from their 52-week high by, let's say, 40% or more. And let's add an element of valuation here. So price to earning multiple, the P ratio should be less than 30. Okay, let's see how many companies do we get here. Wow, it's still 800 companies, but yes, it's all kind of companies. So let's do a market cap sort. All right, some familiar names, Blue Jet, Shakti Pumps, Transformers and Rectifiers, blah, blah, blah. Okay, how about this one? Aurionpro Solutions. It's into IT, it's a technology company, and it's down by a good 45% from its 52-week high. This entire year has been bad, but only from a stock price perspective. Otherwise, from a sales growth perspective, the last 3 years, it's been 30%, 38%, and 29% in terms of sales, profits, and EPS, which is actually quite good. The OPM is 20% plus. The PEG ratio is 0.36. P ratio is less than 30. Yeah, this seems like a good candidate to investigate further. Let's go in a bit. All right, let's examine the price. So at its highest point, this was almost 2,000 rupees, and today it's at 1074. So in a matter of 14 odd months, the price has almost halved. That said, the share price was a fraction of what it was some 3 years back. I'm sure there's an explanation for this in the numbers. And see this. Until FY23, the sales was within a range of 600, 700, 400, 500, 400, 300, 500, 600. And it's actually in FY24 that a sort of breakout happens. And as the sales of the company went up, so did the share price. And not just sales, so has the profit from 102 crores to 205. So that's exactly double, while the EPS is up by some 70%. I think it'll be interesting to understand what happened during this phase here, as in what led to the company growing by almost 4 times in the last 4 years. Is this growth sustainable? And most importantly, do we have an investing opportunity here? All right, so to fully appreciate Aurionpro Solutions' current strategy and market position, it's important to understand the company's history first. So the journey started in 1997 as an IT services provider, and in 2005, the company entered the capital markets with an issue of 27 crores. The next 2 decades saw rapid expansion, both geographically and through a series of strategic acquisitions as the company broadened its service portfolio and market presence. But much like what IT service companies are facing today, by the time 2019-2020 came along, Aurionpro Solutions found itself in a disruptive environment that presented challenges not just to its focus but also to its profitability. And thus started a period of review and recalibration of priorities as the management adopted a clear 3-pronged strategy to reshape the company's future. This was followed by a strategic decision to exit the cybersecurity business. And more than a simple business transaction, I'll say this investment did a lot more by freeing up money from a non-core asset. It made the organization more focused, and it gave leadership the space needed to pursue its bold product-led growth plan. I'll definitely come to the specifics, but while we go through this entire understanding of Aurionpro Solutions, I'd like you to think of everything from the management's perspective. That is, their focus, their approach, their reaction to disruptive forces, their ability to see the signs, their proactiveness, etc. In fact, this is what their chairman and MD, Mr. Paresh Zaveri, said way back in 2021. And as we enter 2026, the company has so far lived up to this mission statement. It shows up in terms of their sales and stock price performance. And while most IT companies have struggled on both parameters, Aurionpro in these last 3 years, and thanks to the new strategic direction, have delivered over 30% in sales and over 80% in stock price return. So let's understand what the new Aurionpro Solutions is into and how it transitioned from a service-led IT model to a high-growth enterprise with its own IP, intellectual property, and platforms. Again, I have to go back to the management, and the appointment of Mr. Ashish Rai in 2022 was a critical catalyst to the company's ambitious vision. Mr. Rai, who is now the group CEO and vice chairman, is a fintech veteran who has built and scaled enterprise software businesses across banking, payments, and financial markets with senior leadership roles at FIS, Finastra, and Coforge. This change, along with some fresh faces in the leadership, provided strategic direction and a product-centric mindset as the company embarked on its IP-led strategy revolving around enterprise applications, software platforms, and payment systems. Internally, Aurionpro divides itself into two verticals: banking and fintech, which covers transactional banking, corporate lending, payments, customer engagement, and the integration of enterprise AI. And then there's the newer but promising technology innovation group that focuses on infrastructure related technology, so things like transit solutions, data centers, and also smart city initiatives. Let's quickly run through this. So on the transaction banking front, iCashPro is the company's primary offering, which is an API first platform that covers the full spectrum of corporate banking. The State Bank of India opted for iCashPro last year in a landmark 100 crore plus deal, as did some other banks in the UAE, Saudi Arabia, and Sri Lanka, and also UCO Bank in India, which has opted for Aurionpro's cash management technology. On the lending side, Aurionpro offers Smart Lender, an end-to-end integrated credit risk management system that works across the board, that is retail, commercial, SME, etc. The solution has already been opted by many players across Malaysia, Vietnam, Philippines, etc. via Integro Technologies, which is a subsidiary of the company. Other offerings include AuroPay, which is an RBI authorized payment aggregator. Then there's Interact DX, which enables banks and institutions to deliver personalized interactive communication across channels aimed at improving customer experience. And finally, there's Arya.ai, which is central to Aurionpro's strategy of becoming a global enterprise AI player for banks, insurers, and lenders. Let's do the other segment as well, TIG, that is the Technology Innovation Group, which addresses the growing demand for intelligent and efficient infrastructure. So firstly, there's smart mobility and transit, which is definitely moving from closed loop to modern open loop automatic fare collection systems. Aurionpro has secured major wins, including the Mumbai, Delhi, and Chennai metros, and is a key technology provider for the Haryana Happy scheme. The company also offers a full suite of services for data centers, including design, consulting, engineering, and program management. Aurionpro has won some big projects in this field, and in a CNBC interview, Mr. Rai did point out to its increasing revenue contribution and high growth rates. So essentially, we're looking at a banking stack, a fintech stack, payments, enterprise AI, transit, data centers, which might seem very small, smaller than the whole, but each of these have a massive market in itself. These are definitely fast growing sectors, and in terms of a demand runway, these go out at least 6 to 8 years in the future. The management identified these transformative spaces way back in 2022 and have been building capabilities and IPs on it for the last 3-4 years. This transformation shows in terms of revenue as well, with revenues expected to more than triple since the Vision 2030 initiative began some 4 years back. Aurionpro's shift was not just a product mix change, but also the way it operates. For instance, Aurionpro today commits a significant R&D spend of 7 to 8% of its annual revenue that then fuels its product development engine. While this R&D is typically expensed through the profit and loss statement, the company does make an exception by capitalizing some of the payment and AI-related expenses to the balance sheet of the company. Aurionpro's second major shift is its use of strategic acquisitions. I did mention a couple of them earlier in the video. Interact DX, the customer engagement platform, and also Arya.ai. Both of these were acquisitions. The company did that in 2023 and 2024 respectively. And Aurionpro has been doing a bunch of these. Like this one here, Infrarisk, which specializes in lending software solutions and can help Aurionpro expand into Australia. Fintra Solutions, which was acquired earlier this year, is into trade finance, and the stock market seems extremely delighted with it. Fenixys SAS, not sure if I said it right, is a Paris-based financial services consultancy that should help with the company's expansion into Europe. Arya.ai, we've spoken about it, and along with Interact DX and OmniFin Solutions, the company has spent over 1,000 crores in acquiring these companies and also in R&D expenses. As you might have guessed, Aurionpro is expanding geographically. It's currently present in more than 30 countries, and while for its core Asian markets, the company relies on a direct sales channel, for expansion into the US and Europe, it leans heavily on strategic partnerships, which is a rather acceptable strategy. In terms of revenue, about 2/3 of it is domestic, the India business. But with the company keen on expanding beyond its stronghold, this mix might look a lot different by the time we get to 2030. That said, Aurionpro continues to add clients. It brought in 42 new clients in FY25, taking the total active count to over 350. And in just the first half of this financial year, FY26, the company has added 35 new clients, which should augur well for business growth over the next 12 to 18 months and beyond. Okay, so this was a historical account of Aurionpro Solutions, also a view into the future, at least from a product and strategy perspective. And let's now convert this into a number, at least in terms of a forecast. Okay, so revenues have been increasing by 30% like clockwork. And if you take the last two quarters, Q1 and Q2, so this comes to 695 crores. So getting to that target of 1,500 to 1,600 does not seem to be a problem. This is in line with the management's own guidance. The order book supports it, and as compared to FY25, this comes to the usual 32% growth in top line. Let's come to FY27, and the chairman, Mr. Zaveri, said with great confidence that Aurionpro is geared to do 2,000 crores by March of 2027. Remember, this is a company that did merely 370 crores of sales in FY21, some 500 crores in FY22, and since then it has delivered growth, and it today has ambitions of doing 2,000 crores of top line in the coming financial year. Beyond 2025, the stock of Aurionpro targeting 5,000 crores per the CNBC article, and I watched this entire video. But nowhere did Mr. Ashish Rai offer this number, 5,000 crores. But the way things are going and assuming a lower growth rate of say 25%, so 2,000 crores multiplied by 1.25, that's 25% growth rate raised to the power 3, would give us almost 4,000 crores. And so forecasting a revenue of 4,000 crores by FY30 doesn't seem too far-fetched, at least to me. That said, I'll definitely encourage you to do your own research on this matter. To help out, I have attached a few resources in the description of this video. Do have a look at that. And now let's look at the margins. So the EBITDA is an even 22%, although it has come down to 21 and has been 20% over the last 3 quarters. But it still is within management's guidance of keeping it between 20 and 22%. Even if we were to forecast this for FY27 or even FY30, then I think, so it's strictly my opinion, but I think a 20% EBITDA margin and a 15% PAT margin is quite an acceptable number to have. I say this on account of R&D expenses, those 7 to 8% of revenue. And if one thinks of it, the management always has that option of reducing it by a percentage or two and adding it back to the margins. For now, Aurionpro is not doing that, as the company is keen on keeping its R&D budget high and their margins stable. So based on all this, I think this is where we are. I've made some estimates for FY26, 27, and also FY30. So as I've already shared with you the strategy, the plan of action for the management, feel free to tweak around these numbers to support your own modeling. However, if I were to build a financial model, and let's take FY30 here, after all of us are long-term investors. So basically the top line is 4,000 crores and we have a 15% PAT. Let me pull out the calculator. So, it's just a guesstimate, but 4,000 crores multiplied by a 15% PAT margin gives us a PAT of 600 crores as of FY30. I also think a business that's growing at 30%, a technology business growing at 30%, deserves a price earning ratio, a valuation multiple of at least 25. So let's go with that for now. So 600 multiplied by 25 gives us a potential market cap of 15,000 crores for this company by FY30. Everything's an assumption here. And in terms of stock market appreciation, stock price appreciation, we have 15,000 market cap divided by the current market cap, which is 6,000. This comes to 2.5. Let's do a annualization of it. So 1 divided by 4 years, 4 months. That's the time period. That's the difference in time from now and March of 2030. So that's 4 years, 4 months. So 4.33. This gives us 1.235 minus 1. And that potentially gives us a stock price appreciation of 23.6%. As you can see here, it's a very simple back of the envelope way of estimating things. Between now and FY30, a lot can happen. Some of these expectations can go upwards. It can also go downwards. So to be a little more sure of these numbers, let's look at a few more areas that I think are important to examine. Okay, let's stick to valuations. And the current P ratio is 29.2. When we compare this with the growth rate of the company, which is between 25 and 30%, we get a PEG ratio of somewhere around 1. Please recall PEG ratio, the formula is simple. So in the numerator, you have the current P ratio, which is 29.2 in our case, and we divide it by the growth rate, which is, let's say it's 30. So 29 divided by 30 gives us a PEG ratio of 1. And if you're fans of Peter Lynch, then you can be assured that this particular company, as per the PEG ratio formula, is definitely not overvalued. Likewise, if you're someone who looks at return ratios, then you're going to be a bit disappointed because the ROCE, which used to be 22, 25, 22, has now tapered down to 18. This is as of FY25. And let's pull out the latest one. Okay, let's go here. This one. Yeah, and see this. The ROCE has dipped even further to 16.12%. Now, this part entirely depends on how you look at it. Let me go back to the screener. As you've seen in some of my previous videos, the denominator of the ROCE is very simply, you can either take the total assets and subtract it by the current liabilities, or else you can take the shareholders' equity and add the long-term debt to it. Let's examine the assets part. So this and this. And very clearly, the current assets have gone up because the business has grown over this period. But even in terms of fixed assets, one of the major entries that you can now see is the intangible assets part. This is basically goodwill, which has increased from some 86 crores in FY23 and it's gone up to more than 600 crores. So this is all those strategic acquisitions that the company has done. So it all adds up. And this has basically increased the denominator of that particular return ratio, which is ROCE, which obviously means that what was 23, 24% is crashing down to about 16 odd percent. So you can either run with these numbers or you can give the business a little more time, maybe 2-3 more years, to normalize operations and to give you a more meaningful interpretation of these return ratios. The other thing I want to highlight here is the cash flows. And when one looks at the cash flow from operating activities, it shows 164, 157, which looks good. However, if one looks at the half-yearly information, so this is September of 2025. Let me pull out the PDF. Okay, let's go down to cash flows. This is there. Yeah, cash flow from operations. What you see here as of 30th of September 2025 is negative 87 crores, and it was negative 66 crores in FY24. That is the 30th of September 2024. To this, the explanation offered by the management was practical and logical. So, very simply, a lot of deal making happens in the last quarter of every year. And because the length of the contract is typically around 12 months, a lot of the collection also happens in Q4. So, by the time September rolls in, the execution of contracts is already on, which means cash is generally getting consumed at this time. But by the time March comes in, the cash has started entering the system, collections are up, and this shows up in a positive cash flow from operations number. And finally, let's look at the shareholding pattern. Let's start with the promoter shareholding, and at 26.88%, this is definitely a dampener. Within this, we have Mr. Zaveri, Mr. Paresh Zaveri, the chairman of the company. So he and his family, and there's also Mr. Amit Sheth, who is the co-chairman of the company. So again, he and his family members are a part of this. Let's look at public shareholding and see this. So Mr. Ashish Rai, who is the group CEO of the company, so he has a 7% stake in the company. Ajay Dilkush Sarupriya, he is a non-executive director, so there is 4.23% here. And there's SAMS Financial Services. So SAM Financial Services is also owned, as in, Mr. Sarupriya and his family, they are directors in this company. So again, that's his. So that's 4.23 plus 2.9. So that's an additional 7%. So 7%, Mr. Rai, 7% is with the Mr. Sarupriya and family. There's also Sundar Iyer. So, Vanaja Sundar Iyer, I think this is same person. So there's Sundar Iyer, there is Karthik Sundar Iyer, there's Vanaja Sundar Iyer, Siddharth Iyer. So a combination of this is, it's again a pretty decent number. It's again about 7 point something percent. No, it's 8%, okay? So together they hold about 8% of Aurionpro, and these guys are generally long-term investors. So I'm pretty hopeful that they're going to stick around with the company as long as it is growing and it's able to either match the expectations or exceed expectations. In addition to these guys, I can also see a lot of other investors who have 1% or more in the company, which is not a small number. 1% of a 6,000 crore NCAP company is 60 crores, which is definitely not loose change. And I won't tag any of these guys as retail investors. Okay, I can also see a lot of FII participation. So there is the Malabar India Fund, Steadview Capital, Goldman Sachs, Verenium. So 15% is a very decent number, and somewhat of a disappointment is that the domestic institutions are not participating much in Aurionpro. I think this 1.9%, 3% that you see, it's mostly Motilal Oswal. So this is on account of Nifty Microcap 250 index fund, and I think Motilal Oswal has some 1 lakh shares in this company. So FIIs are showing a lot of confidence in this company, domestic institutions not as much. But a question which I'm sure is bothering you, and it's bothering me as well, is that for a company that's growing at 30% per annum, it's a technology company, it's into high growth sectors, it has excellent margins, it has very competent management. So with all these factors working in its favor, why did the share price of this company fall by almost 50% over the last 1 year? It's a very valid question. I'm sure you too are thinking about it. And here are some answers that I could come up with. So firstly, there's overvaluation. And at the same time last year, a rupee's worth of Aurionpro profits was being priced at over 50 rupees. Secondly, there are market sentiments, which is probably leading to an overall decline in the share price of small and microcap companies. And furthermore, IT stocks and especially AI-related technology stocks are feeling the heat. Of course, I should point out that Aurionpro has a lot more than IT, but जब sentiment ही खराब हो तो मैं किसको जाके समझाऊं? Honestly, there is no end to speculating why the stock price is down, other than the three reasons which I listed. Someone might say perhaps the ROE and ROC of the company is declining, so that can be one reason. The other can be expectations. The management said 30% growth, but in quarter one and quarter two of this financial year, it's only been 28% and 28%. Uh, Another reason can be that so there are a lot of people who don't like inorganic growth, as in companies which actually acquire other companies to grow. So that's sometimes taken in as a negative thing for people. I don't know. तो कुछ भी हो सकता है basically. There is no limit to this. And if you have a more viable theory on why probably the stock price is going down, do share it with me in the comments box below. All right, so we've discussed quite a bit on Aurionpro. So let's quickly recap. Our story really started in 2022 when the company made its successful pivot from a service-led to an IP-led model. Aurionpro's current stack is diversified across high-growth segments covering banking, fintech, payments, transit, hybrid cloud services, and data centers. While India contributes 66% of the revenues, the company is expanding into the US and Europe as well as in Southeast Asia. Aurionpro has acquired many businesses in the last 2-3 years: Arya.ai, Interact DX, Infrarisk, Fenixys SAS, Omnifin Solutions, etc. With regards to new clients, the company has definitely picked up the pace and has over 350 active clients in its roster. We're getting used to a growth rate of at least 30%, both in terms of revenue and profits. Aurionpro's margin profile is likely to remain in the 20 to 22% range for a few more years, that is the EBITDA margin, while PAT margin would be in the 15 to 16% range. R&D is an important part of the company's ethos. Aurionpro endeavors to spend 7 to 8% of its revenue on it. The management has proven itself to be capable, growth-oriented, proactive, and has a track record of delivering outcomes. And thanks to the recent decline in share price, I think the company is now in that fairly valued zone. But please don't go with what I have to say. I have this habit of being wrong, so kindly do your own research. Just to put it out, we have not looked at risks and concerns. I have not examined any competitor. Debt in the company, related party transactions, none of this has been done. So there's a lot more work to be done. But the way I look at Aurionpro, at least in the context of Learn on the Go, is that I see it as evidence that if a good set of people, a good team comes together, then they have the ability of transforming a business in a very remarkable way, which can be very rewarding for not just those guys, but also for shareholders of the company. That's the way I look at it. So it's just another tool for you to have in your own checklist, which can help you find companies that are very right for picking up and investing. Again, not a recommendation, but just giving you certain ideas on what is possible. I do hope you like this presentation. If you have any questions, please drop it in the comments box below. And yeah, thank you so much for your time. I look forward to catching up with you very soon. Bye-bye.